Good morning, everybody. It's Monday morning, November 9th. I'm Lee Seiler, and this is the Seiler Wealth Management video blog. Thanks for joining me. Let's get right into it. I know there are a lot of question marks about interest rates because last week the Commerce Department came out with the jobs report, and our economy just absolutely knocked the cover off the ball and added 271,000 new jobs for the month of October, blowing out any estimates from any economist. And, it's funny because when the economy is doing really well, sometimes that's really good for the stock market. But then sometimes good news is bad news for the stock market. In this case, short term anyway, it looks like good news or great news because we have dropped our employment or unemployment number to 5%. Just so you understand, folks, 5% unemployment is, for all intents and purposes, regarded as full employment. So America is working. I don't care what the naysayers say out there and say, oh, well, there's not as many people participating in the workforce. There's not as many jobs, not as many good paying jobs. I don't care. Fact of the matter is, yes, they're absolutely right. There are less people that are participating in the workforce. Okay? Do you know what that's called? It's called baby boomers. There are 10,000 people turning 65 years old every day. Some of them don't want to work anymore. So it's understandable they want to leave the workforce. But I don't care how you get there. 5% unemployment is good. So the stock market went down on Friday on the news. Okay, the stock market is indicating lower today. Here's why. Now, the onus is on the Federal Reserve. They have a December meeting. Everybody thought, well, the Fed surely wouldn't raise rates in December for Christmas. Of course they could. It's their job to normalize the economy. We have not been in a normalized interest rate environment. The Fed has not raised rates in about a decade. We have had very unnormal interest rate patterns. Case in point, how many of you out there have a 3% mortgage, or some people have less than 3% mortgage, or a 3.5% mortgage, or a 4% mortgage, or a 4.5% mortgage? That's not normal. Okay, that's not normal. So what we are is we are really mortgage and loan spoiled, because I hear people saying, oh, well, I got a 4.5% mortgage. You got four? Wow, I got 3.75. You like to brag about how low your interest rates are. Guess what? Be glad you have them. It didn't take any skill getting them. You got lucky, okay? Let's see how lucky you get 5 years from now. But let's see how this can affect the economy today. The Fed could raise rates in December. I would say there's probably, at this point, because the news was really good on Friday, it's probably jumped to a 50% chance the Fed could raise rates. 25 basis points. Do you know what that means? That's 1/4 of 1%. Do you further know what that means? I'm going to make it even easier for you to understand. You are out there. You're looking to try and get a $200,000 mortgage. Oh my gosh. Our rates are up 25 basis points. That means I probably have to have a mortgage payment that's maybe $20 to $25 more a month for 30 years. Okay. I know when you look at the 30-year point, yeah, that's a lot of money over 30 years, but how many of these people buying a house today and a $200,000 mortgage and hold that mortgage for 30 years? Not many. Secondly, is that if you're cutting it that close to buy a house and $25 a month makes a difference, you probably shouldn't be buying a house. So here's what you need to do. Yes, are the costs, the financing costs, going to be a little bit higher? Absolutely. But we are at 0% interest rates as far as Fed funds, between 0 and 25 basis points. So the Fed will be very slow in their intervals to raising rates. They're going to probably raise, if it's not December, it'll be early next year, 25 basis points. Then they'll see how it filters through the economy. Then they may say, okay, let's bump it another 25 basis points. Folks, when I tell you that rising rates from here, from these levels, is a good thing. It shows that the Fed has confidence that this economy is growing. And what would you rather have? Would you rather have jobs? Would you rather have good exporting? Would you rather have a business? Would you rather have small businesses starting up? I'm seeing restaurants and small businesses popping up everywhere. That's fantastic news. That's great for the economy. Small businesses rule this world, okay? So, here's my recommendation. If you have an adjustable rate mortgage, and I have friends, we've talked about it, If you have an adjustable rate mortgage and you had that rate for 3.5% for a lot of years, that's great. All right, you've really taken advantage of the system. You've done a really, really good thing for your financial well-being. So you have to just call your mortgage company or call your lender and ask them, how much can my rate go up per year for a maximum of how many years? Because sometimes rates, they'll say, well, we can spike your rate up 1% a year for a maximum of 5 years, or the max we can go up is 0.5% a year for 5 years. So just figure out what that number is. Chances are, if you had the opportunity that where your 3.5% mortgage can at some point end up being 7.5 or 8.5%, you may want to sacrifice now. Check with a mortgage consultant, and if you need a name, I've got a really good guy I've used for years personally. He's in Longwood, great guy. He can just do some shopping for you. And you may have to, if you have a 3.5% rate now, you may have to go up to a 4.25 or 4.5% rate to lock in for the life of the loan. So yes, you may have to pay more on a mortgage today to lock in for future, because you really don't want to be holding on to, when you have a 3.5% piece of paper, you don't want to all of a sudden look 5 years from now and say, wow, I'm paying 8.5% in my mortgage. So the same thing's going to happen with car loans, folks. Right now, you get all the specials, 2.9%, 4.9, 3.9. Those at some point will be a thing of the past. You still have your promotions from the big three automakers, or really the big 2.5, but that's going to change. So this is more normal. Back then was the new normal. And I've always learned that new normals are never always new normals. They change. The new economy, that changed. So, things could either be the way they're always going to be, or always have been, or totally change. We're not going to totally change. Rates go up, rates go down. We've been in a declining interest rate environment, or at least a low interest rate environment, for 10 years. So now that pendulum, which swung way to the side, will start to swing the other way. It's going to be a slow, methodical move upward in interest rates. If anything, I hope it gets the real estate market going again, and people feel they have that urgency, saying, you know what, I better go ahead and buy this house I've been looking at, because that 4,000 square foot house I buy, if rates go up 50 basis points, I may have to only buy a 3,700 square foot house. Okay? If you have any questions regarding interest rates, how you can affect your mortgages, I'll be glad to talk to you. But really, folks, think about this. 50 basis points on a $200,000 mortgage is about $400 to $500 a year. So it's about $40 a month. And that's how you can adjust it. But rates aren't going up 50 basis points. They're going up 25 basis points. That's going to be the first jump. And again, we don't know when. Could happen in December. Could happen in January. But really, the 10-year Treasury is where mortgage rates go by. They're already going up. Okay, so those rates are already jumping up because they trade. They're going to be more normal than actual Fed funds rate. All right. Hey, I'm Lee Seiler. Thanks for joining me. If you have any questions, please contact me through the office, through my email, through messaging on Facebook. Don't forget, we have some events coming up. We are working on a Women in Investing event. It's a great seminar, and it's really strictly for women. Sorry, guys. We'll have a Men in Investing event, and that's called Sports Bar Time. All right. Hey, I'm Lee Seiler. Thanks for joining us. I will have more information for you on Wednesday. Let's have a great week.